Alright folks, this is my third time doing this video tonight. I've had some issues with my audio, so it's usually about time to get a new laptop when it starts to do that. So if you guys have been with me for a while, you'll probably remember issues with my previous laptop. So just so you know, I use a laptop just to do the recordings and to keep all of the mentorship stuff in the same device. I don't like to do anything with the internet with my other terminals. It's just for data. So I put a lot of work on these laptops, and the one that I use primarily for video production, it usually wears out about 18 months or so, a little short of 2 years. So I'll be out tomorrow getting me another laptop. So that was the delay for tonight, and I appreciate your patience and not lighting me up on Twitter or email. Where are you at? All right, so we have the dollar index. This is from the tradingview.com. And again, obviously this is the cash of the dollar index. So I have a weekly chart here. Those of you who have been following me and part of the mentorship for a while now, you know we've been watching this volume imbalance up here. And again, volume imbalance is the absence of any real bodies. Only the wicks have formed the range between this candle's close, 100.51, and the close of this candle here being 99.19. Inside of this shaded area, okay, it's not a supply zone, okay? It is an imbalance. Volume imbalance, where the bodies of the candles are absent. There's only wicks in that range, okay? We will talk more about that in core content if you have not gone that far into the mentorship, so just know that we will provide you more information there. I'm just bringing it out in real-time data. And once you have that on the weekly chart, we're going to drop down into a daily chart. I'm going to scrub back here, and inside of, don't want to do any advertising for Nadex. Man, they pay a lot of money for advertising apparently, because you see them everywhere. They're all over my videos for ad revenue on YouTube. So I guess they're paying a lot of money. So we have a gap that's a standard gap in here that does get filled on the daily. But notice, even though that gap fills on the daily chart, it is a volume imbalance on the weekly. Okay, so it's important to cycle through your monthly, weekly, and daily charts and look for these elements in price action, because that signature, being the absence of any bodies on the weekly chart, shows that there is a very weak delivery of price, and the dollar index will want to most likely trade back up inside that range. Now, once inside the range, which level do we look for? Well, you obviously have the lowest point of the volume imbalance defined by the weekly chart, which is that 99.18 level. So if we zoom in a little bit more here, you'll see that there is a bearish order block, which is also accompanied by a fair value gap. So we have an imbalance of sell side delivery, buy side inefficiency. The low on this candle, take a look up here, right up here, you'll see the low. The low on this candle comes in at 99.37. Okay, so we're calibrating inside of the volume imbalance from a weekly chart. It's not a supply zone. Okay, we don't trade supply and demand zones in here. We look for specific price levels. Now, since the last up close candle here, the low is defined at 99.37, and we have a fair value gap here with a SIBI, sell side imbalance, buy side inefficiency. And again, if you're new, all of this stuff is covered in multitude of lessons. I mean, it's spread out throughout the entire mentorship, but there's also specific lessons that are dealt with on a month by month basis. Go in the order of the lessons. Don't try to email me asking me what's a volume imbalance, what's a fair value gap, which order block do I buy. But there's also specific lessons that are dealt with on a month-by-month basis. Go in the order of the lessons. Don't try to email me asking me what's a volume imbalance, what's a fair value gap, which order block do I buy, which order block do I sell. All of that's covered. Okay, believe me, it's in the lessons. Just you're gonna have to get to it when you get to it. If you think you need it right now, you don't. Exercise patience. All right, so the low at 99.37 is a specific level that we would be looking for, and since we're coming up into it, we could calibrate that to the nearest 5 level, which would be 99.35 and or 99.30, and that would basically accommodate the return back to the bearish order block and allow for broker spreads to allow for your limit orders or targets to be met. Now if we scrub forward a little bit, all right, so here is the high. Again, you can look at it right over here. The high comes in exactly at 99.37. Okay, so you can't get any better than that. It's perfection to the pipette. All right, so that right there above this old high, when it hits this level here, that's going to be a very, very important level to want to cover your short positions on foreign currency, euro, dollar, GBP, USD, cable. In this retracement here, we're returning back into this area here, and we have a small little fair value gap right in here. Now, this portion of the commentary, we're going to take right back over to the traditional demo account that I use through Ava or Ava Trade. But I wanted to bring the index from the cash side of things to outline this, because we have been monitoring the cash index on the dollar through TradingView in contrast to the futures contract delivery that's being shown in Ava Trade's demo. Okay, so that's going to be the distinction between the two, because when I go over to the demo account, obviously you're going to see some slightly different delivery of price and the way the candles look, but the cash did exactly what we were looking for, trading up into the volume imbalance, hit a bearish order block, and right to the point of 99.37 as seen here. We have a BISI in here that had been rebalanced. We're back to an old high, so we are at a discount array, and we'll look to see if we want to come back up and rebalance to this low at 98.80, and then what we do from there, we'll have to basically see. It's non-farm payroll, and non-farm payroll Friday, that week of the month, is usually high probability trading up to Wednesday's New York Open, and then after that we want to more or less sit on the sidelines and not do too much, because the market can get a little bit squirrely setting up for NFP or non-farm payroll data on Friday, which generally is a carnival ride, but I'll see if I can do something with it for the benefit of those following on Twitter. Not because I want you to try to trade in it, but I'm going to be looking for IPTA signatures in price action on Friday to see if I can do something with that as an exercise. Okay, and I'll share that with you guys by way of Twitter as well. Moving on over into the Ava Demo Trade account so we can see the dollar index from that perspective. All right, so we're looking at the Ava Trade demo account and their version of the dollar index. So it's going to be slightly different from what you saw on the index, or cash index, if you will, from tradingview.com. Now, right away, you're probably thinking, oh my goodness, ICT's got trend lines on. What I want to show you is, and I mentioned this in passing the other day, last time we gave our discussion on the dollar index from the daily chart. I was looking at these lows I mentioned without actually drawing the line on there. I felt that this, I don't like that. I never like to see those types of things because they're, to me, many times a phantom. Okay, so you like to see that touch, and it rallied through, it broke through. Okay, I'm wondering if this is going to be, because we did trade up into the cash index volume imbalance on the weekly chart for the dollar index. Okay, so we've traded back below this high, which is something I said I would rather it not do. But when we slammed up into the volume imbalance here, that also gave a willingness to want to probed alongside on the euro dollar, which you saw me actually do, and the limit order was filled on that as a result of trading to its 110.20 level. That was on the heels of this volume imbalance being tagged on the dollar index. So everything is a mirror image. What I expect to see form on dollar index, I'm wanting to see the opposite form in euro dollar and on British pound versus USD. The parameters we outlined in our weekly review on Saturday that just passed, we had no willingness, or I had no willingness, to see dollar index go back below this high. If it did, it would be highly suspect of a false break, and especially now since we've seen that the weekly chart for dollar index cash did in fact trade up into its volume imbalance, did a complete to the point at 99.37, retraced back to a bearish order block, and we had since a beautiful delivery price on the downside. So what can happen in here? So one of the things I'm watching because of non-farm payroll, we have Thursday and Friday's data coming out that are basically lined up with employment numbers. I want to watch this old high. We could see it come back up and retrace there and then make a willingness to go lower. The only way that I would feel that this was extremely bullish is if we just plow right through this candle's, if I can get, there you go, that candle's high. So it's got to go back above 99.31 for the Ava Trade demo account data. Again, this is the futures contract delivery price, not the cash index. So I wish they would just do the cash index, but I guess for licensing reasons, I guess they can't do it, whatever. But nonetheless, we have the trend line here. Now, what I want to show you is there is a mean threshold. These two candles, this candle here, I'm using the open of that candle and the close of this candle here. So both of those candles being consecutive and down creates the order block. So I measured the range, the top, which is the open of that candle, to the close of that candle. There's equilibrium. That's what this little blue line is. So I'm looking at 2 points of reference. It just so happens that this point of reference for the mean threshold, if you extend it out, it touches that trend line phantom. Now, everyone in retail will look for this to touch and then rally and go higher. That's the normal retail perspective. Now, we've already had 1, 2, 3 touches of this supposed trend line. I don't like that. Okay, so I'm thinking that if we come lower, we're going to break this mean threshold and then attack the liquidity below the middle of the trend line's touch points. Okay, we have 1, 2, 3. All of the liquidity that's been trailed on the longs, it's all resting below these equal lows. Okay, so if we look at that from a liquidity standpoint, sell side liquidity rests below these lows here. So forget this line. So forget that line. We don't need that. Point of interest is here, 97.83, 97.85 in that area. If we trade down to that level, I don't think we're going to be bullish personally. I think it's going to go to that level and smash through it, attack the liquidity here, and eventually want to see these equal lows be taken. We have another area of relative equal lows here for another sell side liquidity pool. Then we have a fair value gap here and then volume imbalance, which we mentioned the last couple of weeks when watching the daily chart for this dollar index. So I don't think that this is all that bullish in here. I think that we've poked our head above that. We're in September. Traditionally, that's a very nice seasonal tendency for a beautiful quarterly shift, which we'll be watching. This may be the beginnings of that unfolding, and looking for a much more meaningful move on the pair. So right now I am not bullish on long term. I'm bullish on dollar, yes, but short term to intermediate term, I'm not bullish on dollar index, and it would need to trade back above this high to get me back in sync with being bullish again. Otherwise, I think we're going to be making an attempt to get down to the mean threshold here. Okay, what changes that? In other words, what makes me believe that this would act as support? If we trade down to it in one single candle, and then it comes all the way back above the order block and closes there. Now, if it does that, then they would have shown a willingness to accumulate new longs in here, and if that candle closes, we may roll into next week with a bullish bias attempting to get above this high here. But if we come down here and close on the lows, I don't think that's going to be bullish for dollar. Okay. Moving on into euro dollar. Euro dollar, we had a beautiful run down into 109.25. If I can get it pop up here. Yep, 109.25. And we had a small SIBI, which is sell side imbalance, buy side inefficiency. This one single pass in downside delivery from this candle's low at 110.41, that's the next point of rebalance. So we have a little bit more to go. The high's been such on this candle at 110.38, so a little bit more we rebalance. I like the idea coming back into the up close candle here. The big beefy body candle, not this little one here, it's too small. This one here, I want to see how we react if we can trade up into that 110.83. So how we trade at 110.41, if we get through that, 110.83, 110.80 would be next upside for euro dollar. So we'll be watching that. If we drop down into an hourly chart, you can see how price trades down into that 109.25 level, going below previous lows, and I took a long inside of this equilibrium with the expectation that would be very close to the smart money reversal of a market maker buy model. If you look at the consolidation in here, okay, we have a very small consolidation, and then we have displacement. Trades lower, you have another area of distribution, and then doesn't quite create the smart money reversal here. We do it here, and inside of this whole consolidation on a lower time frame, after the smart money reversal, then you have a low risk buy in here. The areas over here that we had bearish order blocks form, they are going to be used for buy side of the curve for the market maker buy model, and you can see that happening here. Reaccumulation, and in here we're looking to press up into relative equal highs. Now we did rebalance to the price point of the low here at 110.33. The high so far on this price swing has been 110.38. So I'll be looking for a willingness to want to get above these equal highs. And again, that's the very, very near term objective. But you can see a beautiful delivery of a buy model here. In a lower 15-minute time frame, we can see a lot more definition. So you can see you have a fair value gap in here. Price comes down, it gets into that, and we have a balanced price range with the previous SIBI with a new BISI. Okay, so that's 2 points of imbalance. That becomes a balanced price range. Again, that's covered in core content. Don't ask me anything in the emails, new people. We had a lot of new people come in here, and I know you're watching for your first weekly review or midweek review tonight. So I already know you're going to be wanting to email me, asking me, what was you talking about here? Trust me when I tell you, write down all your questions in your study journal by topic. And then as you get more information and you take more notes, you're going to find your aha moments, because I give you a lot of the answers as we go through the content. So all of the areas where we went up here before going down, now we're trading back down into it here to reaccumulate new longs. In this area here, you can see over here, down close candles are being supported. Relative equal highs, that's what we're looking for next. Now, to this price point here, rebalancing to this fair value gap, which it does here, that's sufficient. Okay, and you saw how I went out of the long at 110.20 on my last portion of that long. It was a really small position. It was only one standard lot. But the 5 minis that were taken off in the limit order at 110.20 was on the basis of trading back up into all of this imbalance here and not requiring it to get all the way up here, because I was thinking it might even just hang around and just chop wood, which essentially it has been doing, but it eventually made its way up into this consolidation, but needs to get back above it, in my opinion, to clear the buy side liquidity that's resting here. The distinction I mentioned on Twitter that I would cover tonight between institutional order flow and interbank order flow. What are the difference? What are the differences between the two, rather? If we have an idea that the market is wanting to be bullish, okay, in other words, it's a bullish buy model, okay, or in a buy program, what we're looking for are up close candles to be broken because they would otherwise be bearish order blocks, and we want to see down close candles find support. So let's zoom in here and I'll give you some ideas about what that means. So we have a smart money reversal here, and then from that point on we want to see up close candles over here, up close candles being smashed through. Okay, market comes down, trades into a bullish BISI, buy side imbalance, sell side inefficiency, fair value gap. Price starts to go higher. Every down close candle, when we trade back into it, it supports price and sends it higher. This is the largest down close candle from this move here. The market trades back down into it. Does it go higher? Yes. Market comes back down again, trades inside the order block, it leaves it. Now we have these two down close candles. Take that range out in time. Does it rally from there? Yes, it rallies. We have the last down close candle here. That's the bigger bodied candle between that one and this one. When price trades back down to that area, does it? Well, it doesn't really quite get to it, does it? It gets the high 97.08, the low 97.52. Okay, so what is that? Okay, so the high on this comes in at 97.08. Okay, so 109.70, and then the low on this comes in at 109.71. So it was only off by 1 pip, but we rally. Fair value gap is closed in here. We rally up, down close candles. We trade above it. Is it supporting price? Yes. We have displacement, down close candles in here. The high 109.84. Mark comes back down into the low 109.84. So is the price being supported there? Yes, we rally. So what is institutional order flow? Bullish. Down close candle, is it finding support? Yes. Down close candle, is it finding support? Yes, rallies. Down close candle, is it finding support? Yes. Down close candle, is it finding support? Yes. Does it rally? Yes. So as we're looking for price to go higher, we're looking for down close candles to act as support levels. Okay, not just an entire range, but we're going to calibrate everyone we come into contact with in regards to a down close candle. For potential bullish order blocks, we're looking at the high and the open, and in the mean threshold of the body. Those are the 3 levels. Now those 3 levels are further calibrated to the nearest 5 level and 0 level. So the nearest one that you would trade to, that's the one you look at for buying or looking for support to be provided for price action. Now the difference between institutional order flow and interbank order flow, we have to zoom back out a little bit. Okay. Interbank order flow is where we have the imbalances here. We have a buy side imbalance, sell side inefficiency. So all of this creates a gap. The market wants to come back down into that area, and that's where interbank will have their orders collected. Institutions, and yes, some measure of interbank is inside of institutional order flow, but largely it's institutions pairing up with the central bank to provide the order flow that you see on your chart. Interbank order flow is going to be where there are gaps. Okay, and what do I mean by that? And all of this area in here where there's SIBI, sell side imbalance, buy side inefficiency, all of this area here is going to be layered interbank order flow. So all of this area here, where it was all imbalanced to the downside, too much sell side, not enough buy side. In other words, it only went down, not enough up movement in here. Look inside this shaded area, how much time they spend working in that range. You see that? All of this is where interbank is going to be working a lot of future price delivery, and you see it happening here. In this area in here, right there, we have again another section of SIBI, sell side imbalance, buy side inefficiency. In other words, only one single candle passed between this candle's low and this candle's high. So all of this is imbalanced to the downside. The market will want to efficiently trade to the upside. The market trades up, passes back down to this level here. Let me show you the low at 110.03, right into here. So you can see we're working inside that range as well. And we come back down to it again here. We touch it here. We touch it here. These levels are not random. Okay, it's not just static noise. It's reacting to this range that's over here. So IPTA remembers, because of this imbalance, it understands that this area here, it wants to return back to multiple times. So you don't see this as a demand zone. Okay, in supply and demand, you wouldn't see this as an area to buy because it's just simply an imbalance. They're looking for areas where there's consolidation, rally, and then that creates an opportunity to go back inside that consolidation and find, a zone. This is an imbalance. The interbank order flow will occur inside that area and respect these specific imbalance parameters. The boundaries that create the high and the low of the imbalance, or in this case the SIBI, they are what is referred to as natural support and resistance. Okay, now natural support and resistance is not the same thing as taking your levels and drawing on old highs, old lows, and expecting the market to return back to those levels and stop dead in its tracks and go the other direction. I mean, think about how many times, like this low here, did it go down to that low and stop and turn around? No, it went right through it. Well, we have a high here, and it did a pretty good job of hitting it there and then trading lower. Yes, it happened to happen there. But what about this low? Did it find support there and rally? No. What about this low? Did it stop price when it went back down to it again? No, it went lower. What about this low here when it traded down to it here? Did it stop? No, it went lower. So that's the other side of the equation. When we have imbalances like this and what we shaded up in here, that's going to be internal range liquidity. And you'll learn about that also in the core content. Interbank order flow exists outside of the chart. That means below old lows, you're going to have sell side liquidity. That's why when you're watching my annotations on my chart, you'll see below old lows or specific levels, I'll have sell side liquidity annotated. And above areas like this, I would have buy side liquidity annotated. What I'm teaching you is where the interbank order flow is, because it's outside of your chart. The chart only shows a candle low to a candle high, and everyone's worried about patterns and levels that create the high and the low. I'm interested in specific price levels above these old highs and below these old lows in the form or range of 10, 20, and 30 pips on a sweep, or 5, 15, and 25 in terms of grades of above and below old highs and lows. Because IPTA will search for liquidity in that manner. So the next question you're going to have is, well, which one do I use, Michael? Do I use a 10, 20, and 30 pip sweep for highs and lows? Or do I use a 5, 15, and 25? It depends on what your ranges are working on. In other words, from this low to this high, is it a 10 level? Like, is it a 10, 20, and 30 or close to that? Then you'll probably have that much of a range above. Work on the 10, 20, and 30 pip sweeps. But if it works out to be like a 15 pip or a 25 pip range between low to high in that dealing range, then you would look for your 5, 15, and 25 pip respectively above the high, looking for liquidity. So what you're looking for is a combination of both of them. Okay, when we're in a trending move, institutional order flow is my go-to. But I'm also referring to where interbank order flow rests just above if I'm bullish or just below when I'm bearish, because that is going to be the primary draw on liquidity. Ooh, see, there's the difference. Order flow is the momentum and how you gauge whether or not, if the delivery of price is being efficient and is it being absorbed from an institutional level. So as price is going up, that's the central bank offering higher prices. But if the institutions are not buying on down close candles, if that starts to not be evident in price action, then what you're seeing is there's a measure of distribution about to take place and the market's going to go the other direction or go lower in that instance. And then you would seek an area of interbank order flow where there would be an imbalance or trade below an old low for the sell side liquidity. Everything I just said reverse when we're bearish. Where we're at right now, we do have a small little imbalance in here. I don't think it needs to go down to there, but if it does go lower, I'd like to see it find support there and then make an attempt to clear these equal highs. That's what I think is going to happen between now and non-farm payroll. What we do after that, it remains to be seen. I don't like to forecast too much with non-farm payroll. Moving on into the cable market. Beautiful, beautiful run below the daily low here. I actually outlined this on Twitter so everyone could follow along. And I shared it on my Instagram as well to try to get people focusing on this one. As the market traded into that low, that's the same moment that we saw the dollar index trade up into its weekly volume imbalance and trade up into its specific 99.37 on the cash market bearish order block, right to the point. Cable has a buy side liquidity pool, and this is our interbank order flow, resting above these equal highs, and then we have a SIBI over here that rebalances to this low at 23.75 and a half. So essentially 23.75 is the next upside draw from an intermediate term basis. Near term, for day trades, we have the high here at 23.10. We'll call it 23.10 because 23.09 is the high. So we would be looking for liquidity above that. So 123.10 would be enough. And where we're at now is 122.40 essentially. So that's a nice little range in there to allow for a low resistance liquidity run for this particular currency pair. I want to look at this area in here. We're going to drop down into that. But actually, before I do that, I sent a chart on Instagram stating that smart money would be selling short here, targeting the sell stops below here. When we get into a lower time frame hourly chart, you'll see a lot more institutional order flow. Okay. And I'll put the daily dividers in here. So here's Monday's trading. Traded back up into bearish order block, which is the last 3 up close candles consecutive. We trade into that, clear some buy side liquidity. Distribution comes into the marketplace, sells off, and then we consolidate before we go into the new day. We distribute price below that old daily low, which is what this level is here. Smart money reversal. Market trades through that old low, comes back down into it, finds support at the old daily low, creates another imbalance to the upside, So this candle here, if we trade back to that 120.80 level, which happens to be an institutional price level, we could be a buyer. It does so this candle here. So you could be a buyer there. Equal highs and consolidation of the original consolidation we left came back. This is a market maker buy model. So every area where there was distribution here, when we get on the left, when we get on the right side of the curve, because this is smart money reversal, low risk buy, reaccumulation, reaccumulation, reaccumulation. Okay. Next area is buy side liquidity above this consolidation, which is identified with this horizontal line here at 2309.5. So again, as I mentioned, 2310 would be my next near-term upside objective. Getting back to my discussion about interbank order flow and contrasting that with institutional order flow. Again, when we're bullish, we want to see do down close candles support price. We have the open here, we trade down into the order block, and we rally. We have down close candles here. Price trades into that. Does it support price and rally? Yes. We have down close candles in here. Price comes into it, trades into it here. Does it find support and rally? Yes. So is institutional order flow right now bullish or bearish for British pound? It's bullish. Interbank order flow is the liquidity pool or buy side liquidity resting above these relative equal highs. That's our draw on liquidity. We have two things working for us. Institutional order flow is supporting price. So we don't have to have moving averages pointing up. Okay, we don't have to have trend lines underneath the old lows. We're looking directly at price action to read the order flow. I don't need volume profiles. I don't need a footprint. I don't need ladders, DOMs. I don't need any of that stuff because I'm going to see it before all those things even begin to identify what would otherwise be hindsight to that. So all those things that you put on your chart, whether it be lipstick in the form of indicators with moving averages, sloping up, drawing trend lines, or if you're using anything like a volume profile or anything like that, it's not necessary. You don't need it. All you're doing is you're referencing the number one narrative, which is we went below this old daily low for sell side liquidity. Why did they want to go down there? They want to absorb that sell side liquidity. Why would they want to do that? To accumulate longs. What day of the week does it occur? Here's Monday. Here's Tuesday. Time of day that it occurs, London Open. So I'm not sure if you watched anything of my free tutorials, but I had a couple lessons, I'm pretty sure, where I mentioned when the market's bullish, it will typically make the low of the week 70% of the time, London Open on Tuesday. And there it is. Okay. So if that's your premise going in, the narrative is we're going to be buying sell side liquidity, pairing that up, and then we want to watch for the displacement. We have it, and then we turn right back to a key level. This old daily low is a discount array. You can be a buyer there. Watch how price reacts inside the down close candles. We open on this candle, trade down, order block, expansion. Down close candles. We leave it, come back down into it. We can be a buyer there. Fair value gap as well. Two things going for us. And then look at this displacement on the upside. This right in here, this right here is a career maker because you have a backdrop of sell side liquidity being tagged, displacement. You already have a first signature that down close candle is supporting price. So there's real institutional buying going on. You don't need to be drawing trend lines. You don't need to do any crossovers with moving averages. You don't need to do any ladders, DOMs, profiles, none of that stuff. None of that stuff needed. At this moment here, what are you looking for? You're looking for interbank order flow above relative equal highs. We have a buy side liquidity pool resting right here. Okay? And then we have the imbalance here. SIBI. So in this area, right in here, price trades up into it there. Now we want to see, does it want to go all the way into it more? And then if it trades on the other side of this, or the high end of that imbalance, or SIBI, the next logical area is the buy side liquidity resting above these relative equal highs. Again, that's interbank order flow. So interbank order flow is the large pockets of large fund liquidity. Large fund liquidity is not going to be inside of these little, smooth price runs. It's going to be on the outside of your charts, below old lows, above old highs, and inside of large imbalances. Now, this may not be determined as a large imbalance for you, but on an interbank level, there's plenty of money that's being offered in this range right here. And that's the reason why IPTA will go back to that area, because those that are in the know will have their orders waiting at that level because they understand how the algorithm will allow them the opportunity to get in sync with order flow from the interbank level. So in summary, institutional order flow is the measurement of price delivery for sustained movement, directional movement. Displacement, and where price will ultimately be drawn to, is interbank order flow. That's going to be the orders that rest above old highs for buy-side liquidity, orders that rest below old lows, which is sell-side liquidity, and the imbalances that exist inside the range. Okay, so we covered that. I just want to roll right over to gold for a moment. And here's Monday's trading, the New York opening range concept I gave you this past weekend. And projected daily high 1530.77, and it went to a high of 1531.09. Not bad. Again, we like to use the round number, not so much the decimals. On the 3rd of September, we have the opening range concept again. Projected high was 1549.87 and 1549.87, and the actual high before we changed into a new day was 115.50. So again, really, really close. And today, or the 4th of September, we have the opening range here, and projected high is 115.56.82, and the high came in at 115.56.92. And we have not made a higher high, and then now we're trading in a new day. Okay, so again, just throw that up there just to inspire you to keep studying it and build a log of how it operates. Now, this is just one component, part of what you learn in price action model number 5 as a charter member. So a lot of you are asking me, can I have this indicator? It's not anything but a Fibonacci expansion tool. Okay, but how you set it up is explained in model number 5, or price action model number 5, once you're a charter member. Okay, so it's not really I'm giving you an indicator. It's always been there. It's in everybody's platforms. It's how you use it to unlock where the interbank deviations are for our intraday volatility. And the last bit of business here is the dollar CAD. I did not talk about this pair, to be fair, but a lot of you actually are in the mentorship sent me charts that you actually traded this today and asked if I would just comment on it. So before I get into this, just know that I already know, and you all know as well, that I did not mention anything about this pair. But I want to just kind of like briefly give the members that requested me to talk about it, my opinion looking at it. So again, Tuesday, high of the week. Beautiful run above an old range here. Let me zoom in a little bit. You can appreciate that more. So we have a lot of what's resting above this high, or these highs. Shouldn't be really there. It should be here. And it probably won't let me do that, will it? There we go. So we have a high, another high, another high. So what's resting above this area in here? Buy side liquidity. Is that institutional order flow or interbank order flow? Interbank order flow, because it's external range liquidity, and it has nothing to do with supporting or negating a sustained delivery of price in a directional basis. So it's outside of the range. So we have that run here, and then we take it one more time higher on Tuesday, and then we're back down below that range. Okay, so what did they do here? They ran stops. In this area here, to this run down, we're going to look at that little area right there and zoom in. So from this high, which is the old high that I mentioned that creates that range, to this low, in this area in here, right in here, we want to see if there's any imbalance and where does the price need to rebalance to. Last two up close candles are in here. That's your bearish order block that would be defined at the open at 133.32, and the high came in at 133.36. And if we drop into a 15-minute time frame right in here, you'll be able to see a little bit of an imbalance in the form of a SIBI. Okay, this candle low 33.37. This candle's high 33.31. We rebalance all the way up to 33.33, but not 37. Notice that one pip. Now I just mentioned this. It was last week. I mentioned how it can just be just one pip that it'll want to rebalance to. Now here's the thing that I want you all to do on Twitter. Don't mention anything outside of what I'm asking for, okay? But on this particular candle, look on your 15-minute time frame on $CAD. I'd like for all of you that have a live account, post what your high is on this particular candle. On the 4th of September, what was your high on this 15-minute candle? This data on a demo is 133.38. Okay, and your order would have been looking to get entry at this fair value gap above these equal highs. That's a buy side liquidity pool above relative equal highs, and it's the rate announcement that came out today. Okay, so I teach you how to trade these in the entry techniques portion of the later months content. You can actually be a seller on a stop down here. So as it runs up here, you're only interested once it starts to move the other way. So that way it takes all the guesswork out of what level you're looking for. And but if you have a bias, if you will, you could get filled here. The problem is if you have a rate announcement, it could be opening the candle here. Your stop is here, but it prints down here. So you'd have a lot of slippage. So that's the reason why we don't like to do rate announcements or FOMC trades with this entry technique. But if you're practicing and you're seeing a bias that's bullish or bearish for the week, and FOMC or rate announcements, and the price action is trading against your intended direction for the week, then you can practice that with a paper trade or a demo trade, and then you'll see many times it'll go the opposite direction. Where does that leave us? I think we'll probably just keep on going lower. Really, the rate didn't really change. I don't think, if I recall that correctly, looking at the economic calendar. So I don't think it's going to be a lot of movement for $CAD on the upside. If we drop out to a 4-hour chart, just get a longer term perspective on what we've done so far. We cleared these equal highs, and I think we're going to make an attempt to run below these relative equal lows. And look at the BISI here. Right in here, we have a buy side imbalance, sell side inefficiency that would rebalance at 31.56. So I guess it's about not 100 pips, but a good amount of pips to look for a low resistance liquidity run for these equal lows. Okay, so you can look at your 5 and 15 minute charts for the remainder of this week and see if we get any kind of fair value gaps or bearish breakers or bearish order blocks or runs above intraday short-term swing highs for buy-side liquidity pools being rated. Use those ideas for practicing, and then look for a run below. We'll look at this low here. What is that? 31.83. Okay, so 31.83, about 30 pips or so. Yeah, with spread. So there's a nice little 30 pip range to work within, see if you get something to work with in regards to a setup there, and leave a piece on and see if you can get this entire BISI to rebalance. If we really lose ground and we take this low out, we have another imbalance down here that would rebalance to this candle's high, 130.71 and a half. So, and again, that's assuming we also see continuation on the upside with the Canadian futures contract. And if you look at the Canadian futures contract for December Canadian futures, you'll see that it looks to me really bullish, and we could see just basically the opposite what we're showing here, because this is a forex pair with the dollar being the first in the name of the pair. So if this is going lower, that means Canadian futures contract is going higher with the dollar index dropping lower. So I want to talk a little bit in closing about what we do and how we look for setups. I mentioned beforehand that we would be looking for the higher dollar, which we got. I mentioned specifically the run on the sell side liquidity for the cable, which we got. How do we go in using the confirmations that I try to give you by way of the commentary I give you on Wednesday and or Friday or Saturday weekend review? If I'm drawing your attention to specific points from a higher time frame, I want you to practice using the lower time frames to get in sync with that. Many of you follow along with that and you get really good results. A few of you, and some of you are actually from my first group, ignore the things I talk about and you trade other pairs in the opposite direction, and you're struggling. And it's very frustrating for me as a mentor, because if I spend the time to talk about specific points of reference in higher time frame charts in euro and cable, it's not something that is encouraging as a mentor when you send things to me that you traded in Canadian dollar or pound yen, okay, or dollar yen, which I don't cover those pairs. I don't do those pairs. I want your focus on euro dollar and GBP USD with the dollar index. Once in a while, like I mentioned, we look at gold. I felt that bringing in gold wasn't a fair thing to do. It doesn't require a lot for me to talk about it, and it's outside of the scope of the two forex pairs that I cover all the time, so it breaks up the monotony. But you want things to be monotonous. You want it to be boring, and the only way it's going to be boring is if you see the same things happening over and over and over again in the same market or markets. So when we had the week open here on Sunday, we had a gap. We have a small little gap in here. It gaps, comes back up and fills that gap in, but trades a little bit more above the short-term high and trades into a buy-side liquidity pool, and displacement comes in. Inside this particular day, we already knew that the low here, the old daily low, which is 120.14 and a half, is really what it was, but I don't know why it's showing here on that line like that. But basically 120.15, we'll just call it. That's what we were looking for as the draw on liquidity, and the liquidity below that, because the old daily low, it's not going to be 10, 20, 30. It's going to be a more significant run below that because it's a daily chart. Inside of the Monday's range, let's go into a 5-minute chart. All right, so we have price running into a Judas swing, old high, buy-side liquidity pool, and we wait for price to create a displacement. We have one single pass down here. Previous candle's low, $21.68 and 8 pipettes. The next candle after the down displacement is $21.66. This is a fair value gap. We want to see price trade up into that. We could be a seller there. Stop above here. We have another imbalance here. What are we looking for? Remember, this down here is where price is being drawn, and below that. So every time we get a single candle, okay, we get a single candle, that. And then we have the previous candle. Which does not need to be an up or down close. It's just, and I'll show you in a second what I mean. When I'm drawing your attention to a lower time frame level, the only thing you need to be practicing and worrying about right now as a developing trader is this. You're going to find 3 candles. Okay? In that range that exists between the first candle in a series of any consecutively printed candles one candle, the second candle, only one pass down. Then the next candle stops inside of the range of this candle. So between the high and the low, in other words, the low and the high, the next candle here, or the third one, doesn't completely come all the way back up to the previous candle that creates that one single candle down here. So your eye needs to be trained, and this is why we were doing that fair value gap back testing exercise that you guys went through, because it teaches your reticular activating system in your brain to identify this pattern. So when I look at charts, my eye goes immediately right into here. I see that. So I know I want to be a seller inside that blue area. And it can be as easy as just getting it to the bottom of that one. So the next candle that trades up ever, how long, Michael? I don't know. It's a limit order. Hit it, sell short there, and the stop would be whatever the previous swing high would be. Go about 5 points above that. Okay, or 10 pips, depending on what your risk model will permit. If you're trading 1% or less, it doesn't make a difference how many pips it is, because there's not going to be that much damage to you. And you're up here. You have an entry here, and you have an entry here. Follow along. We have a displacement here. This candle is exactly like that one. Just like this candle here is just like that middle candle here. This candle here is exactly this candle here. So this shaded area, that's your fair value gap. This is your institutional order flow entry drill. Selling at the nearest easy low-hanging fruit entry. You sell short there. Okay? So selling short here or selling short here, you know, you can demand it to trade all the way back up and fill that in. There's nothing wrong with that. Problem is, you may not get a fill because it may just go up to the bottom of the gap and then roll over. And everyone, if we were to compare notes when there's a fair value gap, the high that goes into the gap is always going to be different across your live broker, because they're always going to be slightly different. And that's the reason why I teach low-hanging fruit. Low-hanging fruit is the easiest entry concept when there's a directional bias using the fair value gap. But you have to be aware and be willing to absorb the drawdown that resides between this candle's high and this candle's low. So it may go all the way against you. If you're just trying to sell short here, you may have drawdown to whatever degree this range is in terms of pips before you even start to encounter what would otherwise be your range in pips that would be in your stop. So you have to be mindful of that, okay? You have another fair value gap here. Okay, you have this candle is this one. This candle is this one. This candle is this one. So it needs to only go above this candle's high or trade to the same high. So 121.01, and it does so here. The next candle you're selling short. Where's your swing high? Right here. Put your stop just a little bit above it. Right in here. So you're selling short here. What are you looking for? A run to that level. Does it get there? Not in a straight line. Look at that. all this time if you're watching.